Alright, in this session we're getting right into the charts to talk about market internals in context. As you used to by now, we have to place everything in context. And the previous two sessions were just the basics of the market internals we use, of the advanced decline line and the NYSE tick. Now we look at how they help us analyze the markets better and how they can be integrated into everything we've talked about that came before them, into one complete picture that helps us analyze the markets intraday. So what you see on your chart is a 5-minute chart of the S&P 500, and above it, in the top panel, is the NYSE Advanced Decline Line. Now, like I said before, you don't have to use the S&P 500 Advanced Decline Line to get good information about the market, even if you're trading the S&P 500 index. They're pretty much the same, very similar. And so I'm using the NYSE Advanced Decline Line because this applies to the other ones better too. If you're trading the Russell or the Dow or the Nasdaq or whatever it may be, this covers more stocks. It's a larger universe of stocks. So we'll just use that for now. So here's our context. We had broken out major breakout from a previous balance that's not shown here. We had bounced more and just broken out really hard to the upside and balancing again. So it's the context is a larger term uptrend and now a big balance for the intermediate term trend within this larger term uptrend. It's a large 1, 2, 3, 4, 5, 6 day balance. Okay, and what we're going to focus on is this current day that's still technically within this balance. I just haven't drawn it over it because we're going to analyze the action in that day as if we were trading it live. So let's zoom into this day and see how using context in combination with the NYSE Advanced Decline Line could have alerted us to this big potential move down beforehand, real-time intraday. So let's take a look at that. Okay, here we are zoomed into the day. Now, this day, right, opened up still within this whole high volume node that stretched from about here to there, right? So we know we're within the high volume node of this major key reference area, of this major balance. We also know something else about balances, and that's the fact that they don't last forever. Eventually, the market's going to break out one side, either to the upside or to the downside, right? Now, given that the context of this market is that there was a previous uptrend and now a large balance, most of the time we would be expecting the market to be breaking to the upside. But sometimes there are things that alert us that, for instance, an intermediate term downtrend is going to come before we resume the larger uptrend. And on this day, the advanced decline line gave us a great tell that was to be the case. So let's take a look at that and move in even a bit closer, zoom in closer. All right. So here we're still within this major high volume node. We know from before, from our training before, that a lot of the times major moves start at those big high volume nodes, right? So since we've been balancing but for about 6 or 7 days and now we're still at the high volume node, we should be relatively prepared that there could be a big move about to happen in the next day or two or sometime soon, right? And we're looking for tells to see which side it's likely to happen on. So this day opens up here and makes an up move. All right? Now, if you look at the advanced decline line, right? Its up move does not confirm this one. The S&P 500 makes new highs, but the advanced decline line is well short of its previous highs. That's the first warning signal. Then the market pulls back and goes to new highs once again. And yet, now the advanced decline line is even not only not at new highs, but not even at its previous high. So this is a double divergence. We have 1, 2 new highs here and 1, 2 new lower highs here, right? We can't break to new highs and we can't even break this previous high. So this is a clear multiple divergence. What it's telling us underneath the surface is that most likely the S&P 500 is rising because it's being propped up by a couple big stocks, right? Maybe an Apple or a Microsoft or ExxonMobil or General Electric or those type of stocks. But the majority of the stocks in the universe are not performing as well as this would have us believe. And so the breadth of the market is actually weaker than the market looks on the surface. And given this, there could be a very good chance that this initial movement would give way to the downside. This is especially compounded by the fact that we know we're at a key reference area and we know that this is getting to be a mature balance that's likely to break one way or the other. And so when we're here and we're finding a tough time rising, right? And let's say we're starting to turn over here and the advanced decline line, all right, is already hitting new lows on the day right here, while the corresponding movement in the S&P is still above its previous two lows. This is showing that a lot more stocks are now being down on the day than they were up. We had opened at plus 1400 on the advanced decline line, which is a positive number. And by this time, we were only at plus 600. 800 more stocks are now down on the day than they were before. And yet the S&P is still here, being propped up by a few of the big stocks. But as the breadth of the market is deteriorating, this is telling us there's a big likelihood that we're going to have a nice breakdown in the S&P. Even here, this could have told us there's a decent likelihood we're just going to break out to the downside and leaves this as the high of the day. And then the breakout move started coming. And not only did it come, it came in pretty sharp, high conviction movement down that was majorly confirmed by the advanced decline line, tanking all the way below zero and getting into the negatives all the way from plus 1400. At this point, we kind of zoom out, right? And we're looking at this and we're saying, okay, we had this major divergence, all this kind of bearish action. We had just tanked down, and this movement down has taken us below this major high volume node that has been developing. Now there's a decent chance, because of this bearish action, because of the bad breadth of the market, that this thing could continue down. Okay? And because we know that the likely high of the day is in, the odds become more for lower movement. Now here we have to temper it with a bigger picture view, right? The bigger picture view, again, was that it's in an uptrend. So very likely it could have been that the market could have came down, tested the bottom of this range and bounced once again. You know, it wasn't saying for sure we were going to have a major breakout out of this balance. But given that we were in a mature uptrend and now a mature balance, odds were saying that there's a decent chance we could break out to one side or the other. It wouldn't be surprising at all to start an intermediate term downtrend within the context of the uptrend. And so we had to keep our mind open to that. The advanced decline line helped us do that very early on. And if we were trading that, we're not getting to strategy or tactics right now, but that would have been a great short. Here's another contextual example. Okay, here the context was a bigger time frame range. We weren't really doing anything. We had gone up, then had come down, and we're just kind of going sideways. And as we know, when we're in a bigger balance, both support and resistance become important. So now if we zoom into here, what was happening? Well, the market had come down, shot up, balanced for about 4 days, come back down to test the low, and now had shot right back up to test this previous high volume node. So let's take a look at this day while we were testing this previous high volume node. All right. The previous high volume node was right around here. So we tested it early in the day on a huge gap up. Okay. And right when we hit it, look at this big drop down. really sharp. I mean, these guys just rejected it right down and pretty much filled the gap right here. But then, for some reason, buyers stepped up and rejected it right back up just as well. So at this time, let's combine everything we know about context and day type and reference areas and now add in market internals with the advanced decline line. All right. So we've been building everything up in a structured manner, layering on more and more to allow you to learn how to analyze this all contextually and add it all together to gain your understanding and experience. So what are we thinking? What's our thought process? Well, our thought process here was that we expected a reaction at this major high volume node, and we got it, right? But then all of a sudden it surprised us with a major buying tail. The buyers, responsive buyers, just stepped in and said, okay, the sellers won here. We still think value is higher, and we rejected it right back up. Now on this really sharp buying tail, we're thinking the odds are pretty good that they want to go and try to test this area again and maybe shoot up through to the upside. All right? So our thought process is, more than likely after such a sharp down move, this should not have reversed this much. And as we're coming back up here, we're now thinking, well, 80% or 70% of the time, the higher low of the day happens in the first hour. This could be very likely the low of the day, all right? And we may be about to put in a major upside breakout that takes us through this whole balance area to the upside. And maybe we're about to trend higher, right? So we're updating our scenarios as things go. But now let's look at what happened with the market internals that gave us a heads up of what was likely to occur. So here we are. We had rejected, balanced a bit, and now we're shooting higher. So we hit the balance, the major high volume node again, and now we shoot through it. So we're beyond the high volume node again. And if you were in this part of the day without seeing any of this, without seeing any of the rest of it, let's light this part up just so you can see it. Okay, at this point, there's no way you're thinking prices are going down. You are thinking this thing is breaking through a key reference area, had put in a major buying tail, the likely low of the day is in, we are going to be shooting higher and higher and higher. And you might be very tempted to buy it right here. And a lot of traders act impulsively and would buy it right here, thinking this is a great momentum buy. But here is where this other layer we're teaching you now comes in to help you refine your skills even further. And here's where it can keep you out of trouble. Let's take a look at what was happening as we zoom in closer. Okay, so here's the advanced decline line, right? True to form, it had opened higher, and when the S&P tanked, it was getting killed too. But now the S&P is higher, and it just shot up very high. But wait, here's the advanced decline line. It's not at new highs. In fact, it's quite a bit off its new highs, even though the S&P is quite a bit over its new highs. So this is really lagging. What is it showing? It's showing that this move is not supported by most of the market. And when a move is not supported by most of the stocks in the market, it's not very likely to be able to continue. Now at this point, this divergence was telling us that maybe this breakout from this balance, from this previous key reference resistance, is not as legitimate as it seems. But is there another market internal that could help us know that this was actually a good selling point, or that this was a good point where it could reverse? Had we hit, for instance, a sentiment extreme? Well, what can tell us that? The NYSE tick. So here now we have the NYSE tick overlaid on top of the chart. As we can see, the first push up after the gap gave us a nice 1000 plus reading, which marked an extreme after this big gap up, and we got this big drop down. The next major push up, this great buying tail, gave us another plus 1000 extreme. This time, since it was just off this fresh buying, it only gave us a 3 or 4 point drop, but nothing major. Now we flew up again, and we've hit yet another buying extreme at plus 1,000. So now, in and of itself, like we saw here, a plus 1,000 doesn't mean the market is going to drop, right? But when taken into context of what we were seeing before with the advanced decline line of the major divergence, and now this is a buying extreme, this can tell us that there's a very decent chance that this is an exhaustion point, that the market had gotten really high really fast, that there was some emotional buying taking place, and it was happening in the context of a lack of support from the rest of the stocks in the stock universe, trying to push through, trying to break out from a resistance area. And when you already have traveled this far up already in a pretty sharp straight line, hitting a buying extreme, not being supported by the rest of the stocks, all those things compounded, right, tell you that the likelihood is that you're not going to be able to break out. And once we take a look at the fact that the whole context was that we were just in a big balance, it's not like we were trending higher strongly to support this kind of move, it was just a big balance area, even on the bigger time frame, then there's a very good chance that we would fail here. And so indeed we did, and we ended up dropping right back down close to the low of the days. Now, the low of the day still held, and it just ended up being a nice big drop, a 10-point drop in the S&P from this failed breakout over resistance. And the thing that alerted it to us were the internals, the divergence from the advanced decline in conjunction with the extreme in the tick. The extreme itself was not going to tell you that alone, right? So never look at these things alone. Don't go now fishing. A lot of traders will see the tick, they go, oh wow, this is the magic bullet. This is the holy grail. All I have to do is see extremes and I know when the market reverses. That's not how it's going to work. But when you compound them, right? When you wait for extremes at key reference areas, for instance, and then add that with divergences and then have the whole bigger context supporting, you have some great compounding of probabilities there. And the odds become much higher for the market reacting. So let's take just one more look now at a time where just a pure simple extreme in the tick at a key reference area gives you better odds that the market will reverse from there and it has put in a short-term extreme, which will give you insights on the day type in turn. So let's take a look at that. Okay, this is a situation that we've looked at before. We've covered it in the drills a couple times too from different points of view. So now let's take a look at it and see how the NYSE tick could have helped us gauge this market action better. Okay, so here we are. This was a major uptrend. It's not shown in this chart, but it was a big uptrend. We have been balancing here sideways for quite a while, gapped up, put in another balance, and now we're gapping through the balance to the downside to hit this major key reference area. So now let's zoom into this day. Okay, here we are on this day. We're hitting this major key reference area. Now a lot of the times it's hard to time exactly when the reversal is going to happen in the market. You may know that there's a general reference area there, but it might be a pretty wide reference area. So you think, well, how do I know, it's easy to look at it after the fact, but how do I know in real time when the low is taking place or when the high was just hit? How do I know? And the truth is you never really know, but there are good ways to have good odds of them. So in this case, if we're hitting a major key reference area in the context of an uptrend, and as we had taken a look at in this example in a drill before, there was equal likelihood of two different scenarios. Either one, we are starting a new intermediate term downtrend, we're just going to keep tanking right through and put in a downtrend day, or two, we were going to just stop right at this major key reference area and reverse right back up to continue the major uptrend. Now the latter is what ended up taking place here. But in real time, if you had decided that the good odds were for an upside move, and if you had decided the risk reward was there for that, well, one way to time the market reversal is to wait for that extreme in the NYSE tick. So let's look at it even closer. Okay, so as this was dropping, we hit one extreme first here that coincided with this bar as we were hitting the top of the range of this key reference area, and as we pushed through and pushed right into the major key reference area, we hit a pretty deep extreme here. Right, we hit around minus 900 there. So going on the scenario that this would be a great buying place, that was a very good candidate for the extreme right there, because of the extreme in tick, because of this emotional selling extreme that was just hit. And then that confirmed that that was a good selling extreme when we shot right back up and we formed a buying tail. Now you'll notice that when we shot up, we hit plus 700 on the tick, right? But we didn't just tank right back down after that tick extreme. We balanced and then we started hitting more higher tick extremes. Usually in downtrends, once you do hit a tick extreme, 600 plus 700, that's the high of that bounce. But here we see we hit it and then we keep kind of going higher. So now we have a pretty good idea that this could have been now the low of the day based on that key reference area. So this is just another example of how you can use market internals to help you read the market better intraday. And as a final word of caution here, all right, I got to be very clear about this. The market internals are very subtle in their uses, especially the NYSE tick. You can get into a lot of trouble by trying to make some straightforward assumptions. You'll see many times when you hit extremes in the NYSE tick, and you'll see many times when you hit divergences in the NYSE tick. Most of the time they mean very little because they're out of context. So try to study them deeply, but limit their uses to when you're at those key reference areas. If you're at a key reference area and you don't know exactly when to get in, you don't know exactly when the market's going to change, using an extreme NYSE tick will probably give you good trade location, will get you in at a good place. Now we're not talking about tactics yet, but just a heads up if you're currently trading right now. Trying to overinterpret it at every little wiggle is going to get you into trouble, because a lot of times it'll do very different things. You know, even in downtrends, sometimes on a strong short covering rally, it could hit plus 1,000. You know, that doesn't mean that the whole downtrend is going to reverse. That could be a perfect selling place. So I can't really give you hard and fast rules for this one. I just wanted to highlight that when you combine it with the other market internal, with the advanced decline line and key reference areas and context, then it becomes quite powerful in helping you time things better. If you try to be too broad in this application, it will get you into trouble. So be careful with this one. But having said that, we now see how market internals, advanced decline line, and the tick can be used when combined with everything else to give you some pretty good reads of the market. So practice looking at your charts, have them up intraday in real time, and learn the subtle nuances of using them to make better trades. The vast majority of the time, they're only going to confirm market action. They're not going to give you any unique insight, the vast majority. But once in a while, at a key reference area, they're going to give you a very good heads up of what's likely to happen next.